What's up, guys? Welcome to the Hamid Talks podcast, episode number 4. It's the 4th episode. This is pretty insane. Basically, the first 3 episodes were pretty fun. We basically went over the holistic view of trading. We went over understanding what the markets are, market makers. You guys learned basically how to manipulate markets in the crypto environment, which is really cool. I would like a person. I'm just kidding. Anyway, in today's video, honestly, let's just get straight into it. We need to talk about the options Greeks. So primarily, you're watching because basically everyone that's watching right now, you guys are very, very well acclimated with how much money we can make trading options, right? This isn't penny stocks. We're not over here trading $1, $2, $3 stocks, hoping for them to go up to, we bought a stock at $3, it just went to $4. We do that in a matter of minutes, basically, with options. So basically, it's incumbent and very, very important for us to understand at least the basics. So the first basics are the option Greeks, all right? So let's get acclimated with that stuff. So let me go ahead and read the definitions of this stuff for you guys. So there's 5 different option Greeks, but there's 4 main ones. All right, so let me just talk about all 5. So delta, gamma, theta, vega, and rho. Rho is the only one that basically you don't really need to know. Rho is the effect of interest rate change on an option. That doesn't really apply to shorter term time frames. Excuse me. That doesn't really apply to shorter term time frames, so it's not really that important. So let's get into the most important ones. Delta. Delta measures how much an option's price can be expected to move for every $1 change in the price of the underlying security. For example, a delta of 0.4 means the options price will theoretically move 40 cents for every $1 change in the price of the underlying index. Very simply, for example, if the SPY is at 370 and we have a delta of 0.5 on the option, if the SPY moves up $1 from 370 to 371, the contract can be at $2, and because it has a delta of 0.5, once the SPY moves up $1, that option contract goes up from 2 to 250. Okay, so that's basically how delta works. All right. Traders often use delta to predict whether a given option will expire in the money. So a delta of 0.4 is taken to mean that at the moment in time, the option has a 40% chance of being in the money at expiration. So it's also very, very beneficial to understand the percentage chance of being in the money when you are also trying to be an option seller. I'm going to talk about that a bit more afterward as well. But delta is very, very important in that regard. All right. Gamma is the next important Greek that we need to understand. So I'm reading a definition here. So where delta is a snapshot in time, gamma measures the rate of change. And so I understand this is very, very, whoa, I'm trying to watch a podcast. Why does this sound like this? I understand it's very, very boring. But you have to get through, you have to understand this stuff. So I'm going to try my best to make it as entertaining as possible. All right. So gamma measures the rate of change in an options delta over time. So if you remember high school, shut up. Okay. So in the example above, we imagined an option with a delta of 0.4. If the underlying stock moves $1 and the option moves 0.4 along with it, then the delta is no longer 0.4. All right, so basically what that means, Schwab is doing a very terrible job at explaining this. But so basically what this means is So what we primarily do when we're trading options is we trade the first contract out of the money, which is at the money contract, right? Generally, the delta of a contract more out of the money is less compared to the ones super deep in the money. So if you look at the option chain right now, you could go and open up the option chain wherever you are. If you look at the deltas for the contracts in the money, those deltas are closer to 1. As you get further and further away, the deltas are much, much less than 1. And the absolute highest that the delta can be is 1. Okay, so the most an option contract will move with the delta is 1. So basically, if a stock moves $1, the delta cannot exceed $1. So essentially, what the gamma does is it calculates the rate of change of the delta. Super mathematical. It like, I understand like this doesn't really mean much in terms of like the scalps that we're doing and everything, but again, very, very important stuff. Okay. I'm gonna share this stuff in the channel description so you guys understand basically how important it is to try to understand this stuff. So the gamma measures the rate of change on the delta. As the delta and as that option contract gets more and more deeper in the money, the gamma has more and more an effect. So let's assume that basically the delta is 0.4, right? As it gets closer into the money, the delta is now 0.55. So the change in delta from 0.4 to 0.55 is 0.15. And that is the option's gamma. Okay. The third most important one is theta. And theta is very, very prevalent. So I'm sure we've all experienced theta decay in our lives where we buy a contract and it could be, so basically the closer the expiration date on an option contract, the more that theta is prevalent in the option price. Okay. So theta tells you how much the price of an option should decrease each day as the option nears expiration. If all other factors remain the same, this kind of price erosion over time is known as time decay. So theta is very, very important. And that's generally why contracts that are out the money lose all of their value essentially, because time decay is very, very prevalent. And if you trade zero DTEs, 0 days to expiration, those are the contracts that end up paying the most because those are the most risky because of theta. Do you understand? So if we were to enter, so in my day-to-day trades, if I want to enter into something safer, then I end up getting something further out. That further out is because we don't want to get killed by theta. Does that make sense? So we give ourselves cushion and it gives us comfort because we don't have to deal with theta eating away at the contract premiums. So that saves us, okay? And this is the fourth one, Vega. Vega measures the rate of change in an options price per 1% point change in the implied volatility of the underlying stock. So basically, volatility is one of the most important factors affecting the value of options. And a drop in Vega will typically cause both calls and puts to lose value. An increase of Vega will typically cause the option contracts to gain value. All right. So neglecting Vega can cause you to potentially overpay when buying options. All other factors being equal, when determining strategy, consider buying options when Vega is below normal levels and selling options when Vega is above normal levels. So this is basically telling us then that when there is a lot of volatility on an options contract, it pays more and it's more safe to be an option seller because we have an inflated contract price where the contract should not be at that price because the vega is very high and because the volatility is very high. That is why when we trade, say for example, I say, okay, the IV is very, very high. The implied volatility is very, very high. And at those times when the implied volatility is 40, 50%, it's much, much safer to be an options seller. So what an option seller is you have multiple different strategies, for example, where you can make vertical spreads, you can do straddles, you can do iron condors, you can do any sort of spread bet. So if you don't know what I'm talking about, what we do is we just blindly basically buy naked calls and naked puts. That's the terminology for it. All we're doing is we're buying a call or we're buying a put. What people can do is you can sell a call and buy a call. You could sell a put, buy a put. There's many different combinations of things that you can do. And what that does is you are essentially taking advantage of the implied volatility on a contract to capture the price. It's much safer, but you need a lot more capital. But it's a very, very interesting and fun way of trading, right? So those are the four main options Greeks, okay? What you also need to know is that there are second order option Greeks as well. So everyone already understands delta, gamma, theta, and vega, right? There are also second order option Greeks. For example, Vama, Vana, Charm, Veda, and Vera. Many different other Greeks. And let me go ahead and just start talking about those a bit. All right. So, for example, let's start with Vama. So Vama measures the rate of change in an options vega for a change in implied volatility. Charm measures the rate of change in an options delta for a given passage of time or theta. Charm is commonly referred to as the delta decay of an option. Veda and Vera. So Veda measures the change of vega in relation to time. So Veda measures the change of vega in relation to the theta of the contract. And Vera measures the change in the rate of rho with the respect of volatility. So it's important to understand that these things exist because there was a time where I didn't even realize that there was. So basically, second order Greeks are derivatives of the first order Greeks, which is mind blowing that things like this even exist. And then we can start, there's third order Greeks that we could talk about as well. But basically, it's very, very important to do your own research, try to understand what these option Greeks mean, what they truly mean. Do the research to understand the first order Greeks. And if you have the time, try to do the research to understand the second order Greeks as well. It will definitely aid your understanding of trading as a whole, and it will really, really help out. So it's very important for us to look at that. All right. Give me one moment. So yeah, there's that. So I don't really know of anyone else that even mentions second order Greeks, but it's very, very important to understand that something like that exists because market makers, hedge funds, any sort of large funds are using all of these mathematical models to find the best time to enter and exit based on the mathematical values of all of these option contracts. And that's all that this is. This is all just math. That's why, if you're just in tune with what's going on in terms of the pricing and everything, obviously to make money on a day-to-day basis, we don't know any of this stuff. We're not really paying attention to any of this stuff. We're just looking at price action, honestly, right? So you can learn all this stuff. It'll definitely help if you're an option seller. So for all you guys that want to be option sellers, this is definitely going to help. If you want to start doing spread trades and everything like that, it's very, very important to know. But if we're just scalping, we're just trying to make money on a day-to-day basis in terms of like very, very short term, please, there's no reason to overlearn and try to really because at the end of the day, like if you really try to study up and like understand the second order Greeks, a lot of it is a waste of time and it'll just confuse you. But it's good to know. So there's that. I'm glad that that's out of the way. I really just like it. Talking about the Greeks, it's annoying sometimes. But yeah, so there's that. Hope I did a good job. Number 2, we have to talk about insider trading. So for example, we created a company and there's a public database that whenever there are owners in the company that buy or sell positions, it literally becomes public to everyone. And that is currently what's going on. So wouldn't it make sense? Okay, if the CEO of a company began to really buy a lot of shares, maybe we should also try to buy some shares as well. That's a good idea. So basically, that's exactly what a lot of people do. They literally just follow the footsteps of various different insider trades, right? So that's what insider trading is. So what you can do as a very, very easy little exercise is you can go to a website called finviz.com. We could do this together. You could go to finviz.com and you have a bunch of different tabs. Click on Insider on finviz.com. And what that does is it brings up a bunch of different buys and sells of these people in positions of power in these companies. And then you get a list of all of them, basically when they bought, when they sold, how much they bought, how much they sold, literally the amount of shares that they bought, the value in dollars. You can see, okay, this person just bought $300 million worth of stock 2 weeks ago. What happened to the price afterward? This person just sold $7 million worth of stock 1 week ago, et cetera, et cetera. You can go down the list of what all of these are doing. All right. So one really, really interesting one we could look at is the stock VRE. So we have a director here buying multiple times, multiple days, right? At an average of 11, at an average of 12. Cool. All right. VRE. The first buy was on October 12th. The second buy was on October 13th. If you go to the chart, the stock was only trading at $11. The next week, right now, the stock is trading at $15. So we have access to this data on finviz.com. It's completely free. You get access to when these people are buying and selling their stocks because you must report when they are buying and selling to the SEC. And they make all of this data public. So you can literally see, okay, wow, all right, this person has this many shares and they're buying multiple days. It's showing up on FinViz every day for a few days. All right, let me buy some longer term calls. Boom, the stock is up 50% in 2 weeks. Literally, I went on Finviz. You could literally scroll down and look for VRE. Literally shows up, which is it's absolutely mind blowing, right? And this is a very, very simple thing that a lot of people aren't doing. So you could add that to your arsenal as well. You literally just look at the insider trades and you just click on top insider trading this week. You could look at latest insider trading. You could look at top 10% owner trading in the recent week that you could filter and do a bunch of crazy stuff. But that was just one quick example. And it works the best on stocks that are easily manipulated. So what I mean by easily manipulated is stocks that have very low a very low float and low market cap. So if a company owner or a director or CEO is actually trying to buy the stock, it can help push the stock price as well. So it's a really, really good sign. You could use this in Confluence, and you basically just buy longer term calls if you see multiple buy positions, especially if the stock has earnings coming up soon. So if these people are buying ahead of earnings, that means that they know that the earnings going to be doing very, very well. So you can position yourself, and that's exactly what happened. So VRE actually has earnings on November 2nd. So the stock ran up 50% prior to earnings, which is absolutely bonkers. So yeah, that's you could take a look at that. And or they have insider knowledge that like a patent is going to be approved, or an FDA approval, or they have like some sort of knowledge of a partnership with the government or something like that, something positive for the stock price that will move the stock price. Obviously, they're going to want to position themselves and try to make more money because they're not making as much money with the salary that they're making in the company. And if they have power of a publicly traded company, then of course they're going to want to try to profit as much as possible. That brings me to the next point. Nancy Pelosi. So Nancy Pelosi has made my brother Aku a lot of money with NVIDIA, right? What does that mean? So basically, Nancy Pelosi works in the government, right? She has a very, very strong influence on what the U.S. government does in terms of international politics, especially with their in relation to stocks, okay? It is currently not illegal for anyone in Congress to not trade on. You could literally be in Congress and trade on the stock market. And then, so essentially, I can go short on a gun production company, right? And then the next day I can try to make litigation and sue and make it so that like owning a gun and producing guns becomes very difficult. That would maybe cause the price of gun stocks to fall. So you as a congressperson that has control over something like that, the law, you can literally profit. You can literally profit off of what you try to do in terms of politics by positioning yourself in stocks. That's what Nancy Pelosi has been doing with NVIDIA, where she has a large stake in economic relations with Taiwan. Obviously, the U.S. has strong ties with Taiwan, especially with Taiwan, what's going on with China, et cetera, et cetera. So she's been buying and selling NVIDIA and using her as an indicator, using someone in Congress, Nancy Pelosi, right, as an indicator of what stocks to buy is a pretty profitable thing to do at the moment. So she's, essentially if you went long with her, you would have made a lot of money. And estimates say that she's made millions and millions of dollars doing this. And it's not illegal. So it's our job to make sure that we profit off of this stuff as well, because they definitely are. All right. So that's very, very important. And not only Nancy Pelosi, I also mentioned that BlackRock is another very, very important fund that you should also be following. So BlackRock, if you get any news that BlackRock has entered or taken a position in a company, right? That's a very, 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 very good sign that that company is going to do very, very well. BlackRock owns companies in almost every industry. All right. They have over $9 or $10 trillion under management. So, which is mind blowing, right? So you basically have FinViz, you got Nancy Pelosi. There's other paid services that you can use that track all of these different things as well. But basically, as soon as you get news that BlackRock is also positioned in something, you could take longer term calls on that position as well. And it would be very, very profitable, basically, in my opinion, right? So now that that's out of the way as well, we can move forward and start talking about earnings, for example. I see a lot of people, they end up buying options contracts prior to earnings, thinking that they're going to make a boatload of money if the option moves in their favor. So say, for example, Snapchat, right? Whatever. Let's just say, for example, Apple has earnings tomorrow, and the contracts that expire this week have an implied volatility of like 200%. And you buy like 5 point out the money calls, and Apple shoots up 6%. So you're like, oh my God, our calls are now in the money. We're about to make a lot of money, blah, blah, blah. What ends up happening is that sometimes the option contract ends up losing value, and you end up losing money, even though the price in the contract moved in your favor, you end up losing money. Why does that happen? It's because the implied volatility is very, very high. And for earnings specifically, that's why it pays much, much better to be an option seller, because the implied volatility is very, very high. The option premium price is super inflated already. Okay, so usually you position yourself at least a week before. So you position yourself a week before they release their earnings. You should never really take a large position on an earnings play the day before earnings, because it's very, very unlikely that you will make any money. And it's very, like, if you think like a normal day, if the stock price ended up shooting 10% and you have like in the money calls or whatever, those contracts would be up at least a few 100%. But on earnings days, I'm sure we've all experienced this, they might even only be up about 20% if you're lucky, or you'll be red. So please also do not buy any positions for earnings. All right. The next thing I want to talk about is, if you guys watch me day trading, right? And I'm sure you guys do, whatever, right? If you don't, first of all, you guys should go to my YouTube channel, and it's Hamid Trades. I have all of my live trades on YouTube. You could replay them and see exactly when I enter and exit. And basically, you'll see like, okay, sometimes I say like, okay, this looks very, very bullish, or this looks very, very bearish. All right, give me 1 sec. Need to hydrate. So, for example, sometimes I would say, okay, this setup looks very, very bullish, but I don't think that they're going to let it happen. Or for example, today's Friday, right? So we're recording this on Friday. We just had a 230% move today, right? On one of the option contracts. So generally, that doesn't happen. So basically, right, when I say like, okay, a position looks very, very bullish or looks very, very bearish, and I say that it looks bullish, but then it ends up breaking and falling and going the opposite direction. Why does that happen? It's because the implied volatility on the contract is abnormally high. Okay? So I want you guys to understand, and it's very, very important for you guys to get a feel for the option contract's price movement. The only way that you guys are going to do this is if you have the option chain open on the side while looking at the chart. Okay? So what I want you guys to understand is, once again, say for example, the SPY is at $400. Okay? And we buy a contract, and the at the money 0 DTE contract for 2.00. Obviously, it's $200 contract, right? The SPY goes from 400 to 400.15. So the SPY only moved up 15 cents. But then you see the option contract move up 10% from 200 to 220. That is ridiculous. And that is actually very, very terrifying. That should not happen. Because can you imagine if the SPY moves only $1 from 400 to 401? That would be over a 40% increase in the option contract. That is not something that they would want to happen. The reason for that is because the implied volatility is very, very high. And when that does happen, I say that there's only two things that can basically end up happening. Number one, if a setup does look bullish, but the implied volatility is high, and the option contract, so when I say the option contract is paying very, very nicely, or it's paying way too well, that's what I mean. A small incremental move in the stock price should not cause an abrupt move in the option premium. Generally, when that happens, only two things can basically happen. Number one, they want to consolidate the price for a few minutes in a range. Okay? So they're going to consolidate the price for a few minutes in a range to counteract the huge movement in the option price. Okay, so they want to try to stabilize the option price because they don't want to make us rich off of these small moves to the upside. They're going to try to do their best not to make us rich. Do you understand? So they're going to try to stabilize the price. Number two, they can break it below the range. Have, for example, like if we broke it below the range, the option contract can start trading from $2, right? If for this example, it was at $2 to $1.70, right? So we've already lost over 10% in the option contract. But then what ends up happening to the price of the option contract as it goes back above the range is now it's at 190. So they've deliberately tried to break the option contract down alongside the price of the stock so that as we move it back up, we're not going to make as much money. And that is much more suitable for them because they, once again, they don't want us to make as much money. So, and if you're confused about who I mean by they or very, very arbitrary stuff like that, market makers. Market makers don't want retail traders to make a lot of money because they don't want to reward retail traders to understand market dynamics. They want to make retail traders get chopped out. They want retail traders to lose money. They use retail traders as liquidity for their positions. And retail traders account for 35 to 40% of liquidity. And the reason why most traders are not consistently successful is because market makers deliberately manipulate people into selling out of their positions early or into taking bad entry points. And those are two of the main issues that people have with their trading. They either enter at a very, very stupid point, which is fine, it's a learning experience, or they exit at a point where they're not supposed to exit because the market makers are deliberately trying to make them do that. So once again, if I say that a position looks very, very bullish or bearish and the opposite happens, what I want you guys to be cognizant of, literally just rewind this video like 5 minutes and just re-listen to what I just said, because it's very, very important. Keep the options chain on one screen. Watch the chart on the other screen. If you see that the stock is moving very, very small, but the option contract is starting to freaking fly and you're making a crap ton of money very quickly, you should be very afraid and you should start taking some profits, because that move is not going to be sustainable. Today it was. We made 230%. I was shocked. I didn't understand how this was happening, because generally that's not supposed to happen. So it did. So, but today was OPEX, and today was basically like an anomaly. The price continued moving up, even though that they were paying the options premium so well. Within like 4 minutes, 5 minutes of that same trade, the initial trade that we took, it was up like 90%. And that's not supposed to happen. The option premium they were paying us very, very well. And usually when they pay us very, very well, it's not a sustainable move to the upside. But today it was a very, very sustainable move to the upside, which was very, very crazy. So generally that doesn't happen, and I hope you guys are just cognizant of that. So the two things that could basically happen is that they keep it stagnant, or they break it below the range, and then they break it back up to the same price. But then at that same price, the option premium is less, so that if they do bring it up, it won't be as high, and the rate of change of the contract will not be as high, and they won't make as much money, and we won't make as much money. And they don't want retail traders to make a boatload of money, essentially. All right. So I hope that did justice with that explanation. But aside from that, if you guys do have any more questions, because I'm not getting many questions. So if you guys do have any questions, I'm going to remind you guys again to just literally, if there's any questions that I can answer over like dialogue like this, please ask me them. I will definitely answer them. I'll do my best to explain anything. All right. So make sure to drop them in the comments. Make sure to email me your questions. I'm going to do my best to answer them. And maybe in the future, we'll have like some sort of like a screen where I'm like speaking or something like that. But I mean, that's going to be kind of weird. It's not really like a podcast then. It'd be more of a course. So we'll see. I mean, this is episode number 4. We'll see what's up, and we'll see how we grow together. It'll be pretty cool. But yeah, the one question that I do have, first of all, I hope you guys enjoyed today's video so far. But the one question that I do have is, do you like watching sports? So I like, the only reason why I watch sports is because I admire how people respond in very, very stressful situations. So I really, really like to see how people will respond in like high stress environments. For example, I'm Pakistani, right? My family obviously is a mixture of Pakistan and India. Cool. But for some reason, Pakistani people and Indian people, they don't like each other. So I love watching Pakistan versus India play cricket. So the cricket is literally like the biggest sport in the country for each country. And it's very, very interesting to see how normal human beings take the entire stress of an entire country and how that affects their play. That's very, very interesting to me. And so I have a lot of respect for people that can do that at a very, very high level. So I look at what these people are doing, and I try to see what they do to compose themselves. I try to see what they do in terms of like holding themselves up. I try to see what they do in terms of like uplifting themselves and their teammates, etc. So I really love watching Pakistan, India play cricket, right? Just for that sort of competitiveness. And I like seeing it. That's really, really cool to me. The same concept for large sporting events that are like make or break in someone's like career. Like I like to see how someone will respond to something where it's like if they lose, it makes their entire career look like nothing. And it's like I want to see people overcome adversity. And that's what life is at the end of the day. Like we all have adversity. We all have problems. We all have stress. But seeing how other human beings respond to that stuff, what they do to optimize for their performance, what they do for their mindset, all of it is learned. All of it is learnable. And that's the beauty of life at the moment. There's so much knowledge that we can all basically share with each other and grow alongside each other. That's that's the main reason why I'm doing what I'm doing right now. This is all bigger than, oh, I'm Pakistani, oh, I'm Indian, oh, I'm American, oh, I'm Muslim, oh, I'm Jewish, oh, it's bigger than all of that. Because what matters in the next few hundred years is humans, all right? Humans in general. That is the most important thing. We want to try to help the human race. We want to try to help our species at the end of the day. So that is the most important thing. The short-term BS stuff going on that is just used to pin people against each other, etc. None of that really means anything. So the most important thing is to just understand that we're all humans. Everyone is literally going through the same things that you are, honestly. It's just people handle it differently. Some people are in worse situations. Some people are in better situations. But that's the most important thing. We need to evolve as a species. And that's what I'm trying to do. Like, I want to help people. And that's what everyone should be doing. Everyone should be trying to look out for who is on your right, who is on your left. Instead of trying to like fight. And instead of trying to destroy. You know what I mean? Because there's no point of that. And yeah, man, I really hope you guys enjoyed today's episode. Make sure you guys ask some more questions. Definitely some really fun stuff. We're going to, if you guys have any like ideas of like what we can do to make this better, or what would make your experience more fun or better, what we can do better. I mean, this is completely new. So we're all growing together. Like, this would not be possible without you guys. All right. So it's like, this is, like, it'd be great for some feedback. Let me know what we can do better. And I'm just humbled and blessed that you guys are like watching the episodes. You guys are leaving comments like, wow, Hamid, I just watched your podcast. That's mind blowing to me, but it's awesome. So I hope you guys enjoyed Hamid Talks Podcast episode number 4. Thank you so much. Take care. Have a good one.